Is it a good time to buy stocks? Due to a crashing economy and high unemployment in the United States, you may be hesitant to invest in the stock market during these uncertain times. Whether you're a first-time stock buyer or a seasoned investor, many experts say there's never a bad time to invest in the stock market, as long as you have a well-researched investment strategy that prioritizes long-term returns. Below, we'll go over some of the most important factors to consider before investing in stocks. A stock market is a collection of shares in public and private companies that can be sold or bought by almost anyone with sufficient capital. Companies are typically listed on the stock exchanges of the country or geographical region in which their headquarters are located. Dividends and compound interest are common forms of return on investment in these stocks. Alternatively, you can profit from the stock market by purchasing a stock at a low price and selling it when its value skyrockets. Your sale will then be profitable. A stock market is up or down means the general price of a stock has increased since a certain point in time. The stock market is up. Similarly, the stock market is down when prices are falling. These stock prices are typically linked to interest rates, which are generally determined by central banks and the Federal Reserve, or to corporate profits and losses. Don't attempt to time the stock market because you rarely will be able to outwit the system. Timing the market refers to investors who wait for stocks to fall in price before selling them quickly when they rise. Many investors profit from this method, but there are risks and potential losses involved. Often, investors miss out on dividends because they wait for the stock price to fall below a certain level before purchasing. You could also fall into the common trap of investors selling when the price is low and buying when the price goes up. Investors miss out on the large return from the upwards curve. The truth is that no one knows what the stock market will do. As the pandemic demonstrated, it only takes one global event to potentially destabilize the market. Waiting for the right time to invest can be a futile endeavor. Dollar cost averaging is a conservative approach to investments. It is a viable option. Dollar cost averaging is a strategy that allows you to invest the same amount in the stock market on a regular and consistent basis up to a certain total. When the price is low, you buy a lot of shares, and when the price is high, you buy fewer shares. You can use this system to try to make your portfolio less volatile. Although it is not completely foolproof, it cannot protect you from a market in decline. Things to consider when investing. 1. Determine your risk tolerance. When you're young and have no dependents, you can afford to take more risks with your portfolio. However, if you are nearing retirement age or have a family to support, you should be more cautious with your investments. These considerations should also influence how much risk you are willing to take when purchasing stock in less stable but rising companies. How much of your financial security would be jeopardized if these companies failed? Your risk tolerance is determined by how much money you can afford to lose without having to sell your stock. Many people recommend that you pay off your debts and have a comfortable emergency fund before investing in stocks. 2. Establish specific goals. Investing for the sake of investing is not a good idea. Set a goal for yourself, such as saving for retirement or purchasing a home. It will also help you maintain focus when markets are volatile and may be a useful indicator of when you are ready to cash out your investments. It is, however, critical to revisit your objectives on a regular basis. Because change is a constant in life, your needs and desires may shift over time. 3. Consider the long term. You'll go insane watching your stocks fluctuate every day. Instead, consider what your investment will be worth in 5 to 10 years. The stock market was not created to make a quick buck with a few key buys and sells here and there. You are far more likely to see a positive return over a long period of time. This is especially true when you consider that investors have received an average annual return of 9% over the history of the stock market. It also serves as a buffer for bad years when the stock market crashes. In such cases, it is critical to stick with your stocks and wait for them to recover. 4. Expand your horizons. Diversity is the spice of life, and your stock market portfolio is no exception. Putting all of your eggs in one basket is never a good idea. Invest in various industries and foreign companies, or choose exchange-traded funds, ETFs, or mutual funds that hold a diverse range of stocks. And don't put all of your money into the stock market. Set aside some of your money for fixed assets such as real estate to help you weather economic downturns with high unemployment and other crises. Choosing and sticking to a predetermined target percentage for how much of your portfolio will go to stock also keeps you from being tempted to time the stock market. Investing is almost always a smart move. If you have money, you don't want it to sit in your bank account doing nothing. Investing in the stock market allows you to increase your existing capital while benefiting from rising inflation costs rather than being a victim of it. Even when it crashes, the stock market has always been on an upward trend. Almost always, you'll get your money back within a few years. As long as you stick to your investment strategy and keep an eye on the future. Finally, despite the difficult economic times brought on by the pandemic, stable and solid businesses will remain standing and bouncing back in future good times. If you invest now, your investment will grow thanks to compound interest and dividends. Businesses become more resilient in the future as a result of crises because they must adapt to the new normal, whether through policy changes or technological advancements.